What's up guys, my name is Jason. In today's video, I'm going to be taking the time machine back 8 months and reacting to a video of Cathie Woods from ARK Invest bagging up her then $7,000 but now $1,400 price target on Tesla. But let's not waste any time and just get straight into the video.
We talked about Tesla bulls, and we're going to meet one in just a moment. In fact, one of the biggest ones on the street. But to preface that, Tesla's wild ride has left many of the analyst community in the dust. Check out where analysts stood just a year ago on this stock. Average price target was roughly $300 a share, just above where shares were trading at the time. Today, the average price target is closer to $500 a share, and that's more than 30% below where the stock closed today after that distinct sell-off. Next guest thinks Tesla has room to run. In fact, she thinks Tesla could hit $15,000 a share within the next 4 years. Let's bring in ARK Invest CEO and founder Cathie Wood. Cathie, welcome. I know $15,000 a share is not your base case.
No.
It's your reach case. What is your base case of where this $700 stock is in 4 years?
Yes, the base case, it's a 5-year target, so the end of 24, it's $7,000. And we've arrived at that price by weighting the probabilities of 10 different scenarios, including bankruptcy, to be honest. So we've tried to be as fair and balanced as we possibly could be. But our confidence level that this stock is heading for $7,000 over the next 5 years is very high.
So you take out your lowest probability scenarios, you take out the ones that you think just aren't going to work, or the highly outlandish ones where everything has to click exactly right. On what bricks is this $7,000 foundation founded? Is it improving margins? Is it lowering the cost of production of the vehicles as they get up to scale, or what?
Yes, there are 3 sources for the increase in our estimated price target. One is, as Tesla killers entered the market last year, we expected Tesla's market share to go down from 17% globally, that includes China, to something lower. Instead, it went up to 18%. And the reason it
17% in electric vehicles or in all vehicles?
No, electric vehicles.
Electric vehicles.
This is global. There are many electric vehicle manufacturers in China. Very low quality, but very...
Damn, Cathie, that's a low blow, but right now, Tesla has over 80% market share just in the US. Now, obviously, if you factor in things like China and globally, that's going to take a significant hit to the market share, but it just goes to show you how dominant Tesla is in the US. But fast forward now just only 8 months, and it doesn't seem too unrealistic that Tesla will reach that $1,400 price target in just the next 4 to 5 years. So comment down below if you think that they'll actually reach that in the next 4 to 5 years. I'm actually kind of curious to know. And this interview is a prime example of why you should do your own research and come up with your own conclusion. And that's just a life tip in general. Never do something just because someone else tells you to do it, unless it's your mom's. Because you never know, it might be one of the best things that's ever happened to you. Just look at Cathie. She must be pretty happy with her investment. But before we go back to the video, just look at the faces of these anchors. They must have thought Cathie was insane for these price targets.
So what we're learning is Tesla is just so far ahead of the pack. And I'm talking about the BMWs, the Mercedes, as far as range and other important metrics when it comes to electric vehicles. Their battery cost is 3 years ahead, 3 to 4 years ahead of any other auto manufacturer in terms of the cost declines. And so every other auto manufacturer will, if they want to be competitive with Tesla, and I'm including BMW and Daimler and all, if they want to be competitive, like for like, they will have to sell their cars at a loss. At the same time, they're losing their internal combustion engine business. So they have a big problem. So,
are you confident enough in their ability to overcome what I would call sort of manufacturing hairballs that have struck them in the past and caused them to miss or delay production targets?
So nothing is in a straight line, you can't promise, but what they did in Shanghai was unbelievable. Breaking ground and producing within a year. And I think they're taking those learnings elsewhere. In Germany, outside of Berlin, we've been thinking, okay, that's a setup for bureaucracy. They have been welcomed with open arms because Germany doesn't want to lose the auto industry, right? And they don't want to lose the jobs. So, and now we're hearing potentially about Texas. So we think they're going to surprise on the production side now. It took a lot of trial and error, just like with their Falcon rockets. When they were trying to land them, it was failure, 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 then success, and now they've been successful pretty much every time since.
I agree with Cathie here. It took Tesla some time to get going, but now they have 4 consecutive quarters of profit, mainly off their automotive business, and they're about to have another one this next quarter. And Elon literally said that their biggest advantage long-term will be manufacturing, meaning that Tesla finds ways within their manufacturing lines to make their cars cheaper to produce every single time, while at the same time still having the coolest cars on the market. So what this does is it now allows Tesla to take that knowledge and apply it to the next gigafactory, and then the next, and then the next, and then the next. And it just keeps on going. And this is something that Daimler, Audi, and Mercedes just aren't doing. And that's why you'll see companies like Ford and GM go out of business in the next 5 to 10 years, because they don't have engineers that can do what Tesla does. And the pandemic really just messed their financials up as well.
So I think they've gotten the manufacturing.
Cathie, when you take Tyler's question to the next level,
yes.
do you dig in and get granular on the opportunities when you look at the sum of the parts? Is it going to be panels, autonomous drive, or batteries that are the new breakout? Because when we look to Tyler's point, when we look at the cars in production, everyone thinks they're an expert on what they can and can't do with Tesla. But is there going to be shockers going forward where there's going to be a breakout valuation on batteries because their technology is so far advanced?
Yeah, I think they acquired a company called Maxwell Technologies, and they've been very secretive about what that is going to do for their battery technology. So what I just said to you does not even incorporate Maxwell. So yes, we do think there are surprises on the battery front. They have their own AI chip for autonomous, the only auto manufacturer to have one. And James Wang, who worked at, our analyst, who worked at NVIDIA for 8-9 years, took a look at those specs and said 4 years ahead of anything that NVIDIA is going to be able to produce, because it's single purpose, it's not general purpose.
What a coincidence. Just this morning, I was actually watching Tesla's Autonomy Day video, 3 hours long, by the way, and I was taking notes because I wanted to know more about the hardware and the software needed for these chips. Call me a nerd, I don't care. But that's exactly what Elon said during the conference. Not only that they're a couple years ahead with the chips, but theirs are used specifically for autonomous driving, whereas NVIDIA's are used for general purpose because they have so many other customers. And what this does is it allows Tesla's hardware and software to work better together than NVIDIA and someone else's, because that's exactly what they're meant to do. They're meant to pair together, they're meant to work together perfectly compared to someone else's. That's why Tesla will win autonomy, because the next best chip maker is NVIDIA, whose chips can only do 21 teraops, while at the same time, Teslas are doing 144 teraops. That's a pretty big difference in performance when it comes to the next best option, which is a 7 times difference.
So we think they're going to be way ahead of the game on autonomous, and that's where the real surprises are going to be, because autonomous is a recurring revenue, very high margin, almost software as a service like opportunity, autonomous taxi networks. And what you have baked in the cake from the street primarily are low margin gross margins, more like auto, in the 25-30% range. We actually think gross margins, because of their battery technology, could head for 40% on the EV itself, and then the incremental revenues from autonomous would be in the 80% plus range. And we think that's what people are missing. And in our $7,000 target, so the scenario testing, we assume only a 25% chance that they're going to be up and running with autonomous within 2 to 3 years.
Karen, jump in.
Yeah, so kudos to you. I mean, you had what I thought was an outlandish target 2 years ago, or 1.5 years ago, and here we are. And so you have another one, maybe outlandish, maybe spot on. But let me ask you, when you get to this 7,000, to pick your more moderate case, what's it trading at? As a multiple of earnings, or as a what will that valuation then be?
So in 5 years, again, we don't really operate like that. We're just trying to figure out the cash flows and then discount them. But one of the things that I'd like to focus on is the reason this is going to be such a big upside surprise is because Tesla is riding the convergence of 3 major innovation platforms. Convergence. It's very hard to analyze this in the traditional world, right? Auto analysts are not robotics experts. They are not artificial intelligence experts or battery experts. We have 3 analysts working on this model together. all of them are characterized by exponential growth during the next. We are ready for prime time. The seeds for what we're about to witness now, not just with Tesla, but with genomics, with 3D printing, with everything we do. The seeds were sown during the tech and telecom bubble. The costs back then were way too high to play out, for those platforms to play out. The costs have been coming down for 20 years. We're ready for prime time. These are 3 exponential growth trends that are converging, and that is why this is so difficult for traditional analysts to value. This is all we do. We do nothing but disruptive innovation because we have never seen as much disruptive innovation evolving at the same time ever. You have to go back to telephone, electricity, internal combustion engine.
Very bold word choice from Cathie, but the thing is, she's absolutely right here. Although I wasn't alive when the first telephone was made or the ICE vehicle was introduced, you weren't either, so you can't really say she's wrong here. But that wraps up this video. If you made it this far, you're actually a real one. But don't forget to hit that like and subscribe button if you haven't already. But with that being said, I'll see you guys in the next one. Peace.